bullish structure for 2023 and the reasons for it. And we also expected some short-term volatility, which we always experience into options expiry, which we just had last week. But the big boys, footprints, told us that the spec-driven divergence between, you said it's the specs driving this price here, between the price capping bets, these were placed a year ago. Last December 2021, it tends to be the December contract is the only contract where both gold and silver expire at the same time, the largest delivery month of the year. But it is these bets are made a year ahead, usually a year ahead added to, deducted from, but essentially a year ahead. So these bets were running into very strong physical markets. Now, that was really unforeseen at the time. But how could you possibly, obviously you would expect that you could contain the market, therefore you'd make your bets a year ahead. But anyway, so ran into some very strong, unfactored physical buyers. So this is ultimately going to have to be resolved to the upside, as physical buyers are struggling to find sufficient physical supply at the COMEX-driven synthetic prices, and they're being turned. The COMEX is being turned on to get physical and to fly it out to fulfill the orders. We talked about that last time. That's not happened very many times in the past, but this has been a more en masse movement. Now, obviously, there's always plenty of gold and silver supply, but only at the right price, not at synthetic prices. And that's why we get these big delays in delivery, refusal to take delivery, especially in silver. But we'll talk about that in a little while. But so really, how this works is, in an attempt to generate a little alpha on their positions, billions of dollars of bets against the price rises are made this year in advance, which, if you can cap the prices, allows the house insiders to bank these bets and keep the synthetic game going. However, this game has always relied on being able to suck in sufficient speculator sellers. The speculators are the guys who are in the COMEX. They have no visibility into the physical markets. They have no visibility in supply and demand. It's a dot on a screen, and they can be led by the nose. And they have taken. It's how much supply you can get them to take the load off the house insiders. Really feeding these insiders are feeding these supplies into the specs. Now, as far as gold was concerned, these spec-driven naked short bets, they really have failed to account for the effect that Basel III NSFR regulations would have on the paper-to-physical balance. And as far as silver's concerned, it did not account for the global physical markets turning on the COMEX for physical delivery. Now, with that difference in mind, we have to look at them both separately.
Yes, Andrew, and I guess this leads into what the 100th episode was really all about, what the BIS was doing and what this was telling us.
Yeah, Shane, I guess what we were really trying to highlight was that if the central bank of central banks was buying gold, what the heck are we doing sitting on the sidelines was the question. Now, it amazes me as to how no mainstream media wants to follow these footprints. So, as you say, let's start with a high altitude look at gold, and then we'll look deeper. But as we assessed last time, reaffirming our January 2021 assessment, which is as I say, just over a year ago, and we clipped a little bit at the open of the 100th Live from the Vault episode to say that this is what we were saying at the time. What happened was we came along with our first tier liquidity providers and bullion bank contacts. We knew that this central bank elephant was lining up to enter the room exactly 1 year later on the 1st of January 2022. This happened, and how this was going to ultimately force the Bank of International Settlements to square up all its over 500 tons of leases that came into the market this year, and they had to square them up by the end of this year. And that's been happening. And so we picked up on this thread directly after, even stepping back a bit, after the March 2020 EFP implosion, you know, the exchange for physical implosion, which is, you remember we talked about this, where we have this break between the paper market, the physical market. We had COVID, the refiners were shut down, people turned on the liquidity provider and said, give it to me. They didn't have it, so they had to go to the COMEX to cover their shorts. Well, we saw up to $100 spreads per ounce between in their attempt to cover this. Now, so basically, what we picked up on this thread after this March 2020 implosion. You go back to those episodes; it's all there, and it forced the Bank of International Settlements to bring forward these net stable funding ratio compliances in gold, to literally rescue the too big to fail taxpayer funded banks exposed to a 70 trillion gold derivative market from absolute collapse. And this inevitable blow up was exactly what we warned now Bank of England Governor Andrew Bailey about, following our concerns being read out in the Houses of Parliament on the 8th of July 2019. It's all on the records if you want to look at Hansard minutes. And we detailed this in detail in several prior episodes, but there is so little doubt now that this multi-trillion-dollar unregulated gold derivative market tail risk had to be addressed. And if you remember, Andrew Bailey admitted, but there is no regulation. We don't know what's going on in the over-the-counter markets. This forced the Bank of International Settlements to put their own house in order quickly, and they needed to close off the derivative bets against gold. And it's been a slow, steady process, but Western Central Bank gold derivative unwind process is underway, which had to be conducted actually in the face of competing global central bank buying. There is competing central banks out there looking to actually buy gold, and this was a very difficult situation for them. And this event also telegraphed that the BIS themselves would ultimately have to become themselves net stable funding ratio compliant, forcing them to square up and repatriate what was left of pretty much 50 years of accrued naked short bets laid on the books of the agent LBMA banks. And of course, these banks are privileged to have gold accounts with the Bank of England. So we also estimated it would take the BIS a full year to exit these bets. And that's pretty much what happened. And we covered this in much more detail in our last episode, where we drew this public attention to the BIS footprints. And it was no surprise that our Live from the Vault subscribers were able to evidence that the gold swap repurchases had been accelerated into year-end compliance. And it captured the BIS October, it was captured in the BIS October statement. And there it was. They only had 7 tons to cover. And further to this, our first-tier contacts, we talked about this last time, really said pretty much they covered the last 7 tons onto the spec-driven dip into the 1618 level.